rather because of time. For those who are coming for the very first time in any of my sessions, my name is Tsebza, and I'm the coach, the mentor, and the founder of Opulence FX based in Johannesburg. But we have trained, and we still do train lots of traders across, I would even say across Africa, because we've managed to reach up to Tanzania, east of, we've really gotten into the east of Africa. And I'm happy to have some guys coming from Gaborone today. And I've also invited some of our traders, lovely traders from Mahikeng. So I'm hoping Northwest and Botswana will enjoy tonight. I'm not going to waste any more time. What I'm planning to do is that I want to share with you deliberately that which I believe it's more advanced. Some of you have not traded, some of you have traded, but it's always good. Tonight, I thought, let me invite you into my trading room. I've done that for some, but I think some people can enjoy it. Right, so I'm going to be taking you through basically some basics of making a trading plan, why are trading plans important, and what do I call an effective trading plan. So that is going to be the first thing. So it's very important that you can understand what is a trading plan and what the trading plan includes. So as it is right now, let me just quickly do this. Right. Right, that's done. So the first thing is that what is a trading plan? So trading plans are very important for professional traders. If you want to move to any form of profitability, trading plans are important. So one, trading plan simply means that you are not going to be approaching the market in a haphazard way. Remember, these trading plans are used for professional portfolio managers, asset managers, and most of the guys who are matured in trading. They use what you call a trading plan. You are not going to confuse a trading plan with a trading strategy. And I will just give it a good context right now. So a trading plan is not a trading strategy. A trading strategy is that which gives you, the signals to the market. So trading strategies give signals to the market. So basically you use it to analyze the market. Then from there, it gives you gives signals, analyzes the market and gives signals. That is not a trading plan. A trading plan doesn't necessarily give signals. Instead, what a trading plan is more of like a plan that tells you what is your target. And usually we measure it. The effectiveness of the trading plan is based on your risk to reward. So you are beginning to be very selective when it comes to risk to reward. For instance, I'll just be showing you right now. I think that's the first thing. So do not put them together. So generally traders like signals, any signal, I would even say any signal, any. So regardless of any signal, regardless of the RR, they don't care whether how much you're going to lose. So most of the signals some don't even state exactly how much money you're going to lose there. But a trading plan is very specific. It's very specific, right? It is specific to your capital. That's why specific to your capital, how much is sensitive to your capital, how much do you have, and how much are you prepared to risk, and what is your reward. Then it will then take you to say, then look for the strategy that will give you those kind of reward, but they are very sensitive to issue of capital. So an effective trading plan, it's a capital preservation. It's a preservation capital. So it's a capital preservation strategy. So you preserve your capital, preservation of capital or your funding. So most of the traders, though they don't want to lose money in the market, but they don't have any plan not to lose. That's what I said, that you don't have any plan not to lose your capital. So I'm going to be demonstrating in the next few minutes, because this is just a really quick session. So I'm just going to be hitting there and there, because as I've said, I will be allowing those who are going to be still enrolling into the intermediate or into our intermediate, then would have a fully fledged trading plan plus support that helps them. So it's a specific plan, the specific capital, specific risk, and specific reward. Everything is very specific. So there is no haphazardness. That's why it's called a plan. In a plan, we specify. So I'm just going to be taking you now to what I would show you as a proper plan. All right. So I'm just going to show you a plan that we give to some of our coaching clients. So we have been planning and we've been teaching many traders on how to plan their portfolios or their trading from as far back 5-7 years ago. So how do we do it? Develop something like a spreadsheet. Just going to take you through it, just take you through it quickly. So this is a spreadsheet of somebody who wants to be trading his capital or her capital for the next coming 3 months. It can be anything. So in this case, I would like you to note that the plan is starting. Before we can go to the market, we start with the plan. This person has got a 5,000 rands converted into dollars. If it's a dollar account, that accounts to about $270 according to the current one. So currently, when we exchange at 18 rand 50, for those who are in South Africa, 18 rand 50, you get just about 270 there and $90 for risk. And what is recommended for you is to have a capital investment of $180. By the way, let me just correct it. This guy does not have $5,000. This is somebody who plans to make $5,000 in 3 months. And then what is recommended according to this model of trade planning is that we recommend that you deposit $180 to make $270 in 3 months. Remember, it starts from there. So in this case, the basis of this plan is that this trader is using his plan or her plan is to use 1:3 as the risk to reward ratio. So in this case, for every 1 pip or for every $1 of risk, the trader plans to make 3 per trade, by the way, to make $3 or 3 pips per trade in this instance. Right. You will notice that at the end of 3 months, this trader plans to come back. If this plan has failed, the trader will come back with just about, they deposit 180, and after all is lost, they're gonna lose or expose $90. If all exposed capital is gone, then the trader would be left with exactly $90. So this is a 50% capital exposure, right? So for $90 that they want to expose into the market, they will make $270. That converts to a risk to reward ratio of 1:3. Now we take the same risk to reward ratio, and then from there we link it now to we break it down. There is the 270 in this for 3 months. So which means that this trader must make $90 in terms of reward, $90 per month, which converts to $23 per week. That's exactly where our subject tonight is going to be concentrated on. So now he must have a weekly trading plan. What is a weekly trading plan? According to this, he needs to every week make a stop loss or expose $8 and then make $23. Please note that. He needs to make $8 for 23. That is 1:3. But from this, I can tell you, it is not possible, it is not mathematically possible to be trading the market at $8, per week, for $23. The stop loss of $8 is definitely looks like you have got to be trading like 75 pips at 0.01. So of course, I think you can try a 1 trade per week, right? Because if you need to be taking 2 trades per week, then you need to be trading a 20. Don't worry, like I said, I'm just gonna be showing you quickly. Then you need to be trading 38 pips per trade and closing 113 pips per trade. So this is what is gonna be recommended for you. So if there's any one of you who's planning that they could trade plus minus a $200 account, $180 account at 1:3 on a simple, not compounded interest, then you are looking at 2 trades per week, which 1 trade stop loss must be at about 40 pips and take profit must be at about 150 pips. But look at how it's going to change. If you are trading per month, then we change this 3 months. We say, no, perhaps your $180 could be a 1-month portfolio. If you make it a 1-month portfolio, it means therefore that you are targeting just about $270 exactly in 1 month. That would put a risk on you of $90 because your aim is to trade the whole capital in 1 month, right? To come back after a month with 50% exposure, that increases your risk. You can see that. So does it increase your reward. Your reward goes up, but your risk to reward is still 1:3. This one takes your weekly trading batch of 2 trades to $113, 113 pips per trade and 338 per trade. But if you do increase the number of trades, let's say in a batch means at one time. In 1 week, perhaps you go for 3 trades. You can see that if you do this within a month, it can give you even more space for you to take more trades. If you do 3 trades per batch per week, you can trade the market at 75 pips risk for 225. So this is the first thing that I wanted to show with you before I can go to the market. So we start planning first. So this is a specific plan for a trader who is having a specific capital. Like I said, there you can see there is a specific capital to rewind, or maybe just to do it again. There is a specific capital. This person comes to the market with a specific capital. The capital is specified that they would like to make $270 within a period of a month. In that case, by exposing 50% of the capital, this makes it $90 to be risked for the whole month, and $180 is what is required to put in your account. Right. And for you to make $5,000 using 1:3 risk to reward, then that's exactly how we calculate what you need to be making. So, of course, you will not have this until you understand all the details. That's what I'm saying, that tonight is just to show you what is the basis of not just a strategy, not just a signal. I've seen many traders losing lots of their capital because they followed signals, which signals never had trading plans. That is why some of them will be asking them that, no, have your own trading plan. So the trading plan must be based on effective trading plan, must outline before you go to the market how much of your capital would you like to expose for the duration of your trading. You must specify how long your portfolio will be, or how long would you like to make that reward. If you don't specify, it's going to be very difficult for you to break it down into weeks. So many people do vice versa. They just go to the market, they make pips, they make dollars, and they start calculating from there. A good trader calculates backward. You start with your capital, decide how much you want to risk, decide how long will that risk take from, and then from there we can now calculate how many pips can you risk per trade, and even the trading batch. Now, I would like us to leave this at 1 month. We can choose. Anybody of you can choose whether you want to make this to be a, to be a 3 months. It's up to you. Whether you want to make it a 3 months. So because it's a weekly plan, I will leave it at 1 month. Because some of you are intraday traders, I will leave it at 1 month. So this is a 1 month. This is a 1 month plan. All right. So this is a 1 month trading plan. This guy is planning to make $270 in 1 month, 5,000 rands in when you make it at today's exchange rate. Today's exchange rate is about 18.5. So we have put it on our spreadsheet there. That is about 18.5. So all these rands are converted at 18 rands 50 cents. When you're in Botswana, you can convert that into pulas because you fund and you're going to be paid perhaps in pula, or if your money comes in dollars, it will be converted in pulas. So that is the first thing. The second thing, in the next 10-15 minutes, now I'll be showing you, because now your plan is done. Like I said, your plan can either be 1 month, 2 months. Remember, just note that your figures are changing depending on how much months you're going to take. If you want to take the same capital for 3 months, it changes everything. From what I'm seeing, you can't trade $180 in this kind of plan for a period of more than, or plan it on a period of more than 3 months. 1 month is it's a reasonable period. 2 months also is a reasonable period, because I did not change the risk to reward. So I will keep it on 1 month, meaning that you've got only 4 weeks. So in this case, your weekly trading plan would be at 3 trades per week times 4 weeks. All right, 3 trades per week times 4 weeks. If you're going to be basing it on 3 trades per week times 4, it means that each week you need to expose 75, just about 70 for 3 trades. 75 pips is going to be your total stop loss per trade, and 225 pips is going to be your minimum, not maximum, your minimum, your minimum traded pips that you can take close at. Now, I know now here is Tebza. He's wanting to go trade the $200 account, almost $200 account, go into the market for 1 month and make $270, over 100%. Again, by taking 3 trades per week, of which on average 1 trade will be 75 pips and minimum closing would be 225. Now I go to the market. I hope you understand up to so far. So I'm going to show you then how do we look for those opportunities. My portfolio is clear. I've got $180 and my plan for the month is to make $270. That needs a strategy that can yield 1:3. It's a plan. Now I'm going to the market. Now I'm going to my MetaTrader 4. When I get to my MetaTrader 4, now I start using my strategy to scan and to analyze the market. Remember, at the back of my mind, I now know exactly what I'm looking for. I am now, because of time, I'm going to go straight into the charts, which I believe that they could fit into this. Some of you are novice traders. You may not have this amount of analysis. We are already professional. So already we have built the market. We've already used our strategy to scan the market. We know we will always be checking where things will be happening. I'm just going to start with, because I've prepared in advance for you. I'm just going to show you in this case, if you had to trade with us, because this is the signal that we gave so just a month ago. If you had to be buying, we started buying this thing, by the way. We started buying GBP, JPY here. That's the first signal. I'm just going to show you how much if you're trading back for 0.1. This was the signal. This point was the stop loss. So in this case, the risk for this trade was just about 194 pips. So meaning that you are going to be losing 14 Rand. You are exposing about $15, not Rand, $15. Remember again, let's go to the budget. The budget for this guy, for that trade, it's $23 per week. If you need, your maximum allowance is $23 per week. But this pair alone is exposing you $15 on that week. But what I like about this thing is that $15, it means that you can take only 1 trade, or if you go through, or if you go with this $15, then it means therefore that, and this is our target number 1, which was hit within a week, by the way. So now now you're going to be making for $15. This market was giving you an opportunity to make just about $66 in that week. So already $66 would have been in the bag. All right, whether within a week and a half or so, but $66 would be in the bag in this case, right? Because the market did not even go backward. But again, this is not a plan, this is a strategy. If you lack in strategy, all your plans are going to fail. That's how many people lose accounts, because they don't have a trading plan. 2, they even have got bad strategies. So the way that they analyze the market, poor. If your analysis becomes poor, if your plan is even not there, or if it's there, it's poorly done. So you've got 2 poor or bad. You've got bad planning and also a no strategy or a bad strategy. Your chances of success in the market is very, very extremely low. This is how traders swap their accounts. So we can see that according to this, the risk that was exposed to us on this market was extremely, the salmon color, this red color shows the level of risk. The risk was extremely low, the reward was very nice. Over 1:3. If you're looking for 1:3, you found it because it was $45, because the risk is about $15 at 0.01. $15 to expose $45 bang. Right. Trade number 2 came. Here's the signal again. This trade number 2 exposes us in the same pair for more. Right. There is the risk. The same. The buy is slightly higher. The stop loss is at the same point as the previous high. That is why it's important that you must get the trend while it's still early. Join our program. You'll understand what I'm talking about. Right. So in this case, there would be now we are planning to go to target number 2. If you buy from this point, then your risk is increased to $28 from higher buy levels, but the reward is taken higher. So your reward is now going to target 2, because from there we are going to target 2. When you do that, this is 0.01 trading. This gives you $90. So it's the second entry, though it exposes, this is out of depth for those who are trading. This is already out of budget. For the guys who are trading $180 over 1 month, this type of setups don't fit their plan. So we don't call this signal, though it is the correct signal with high probability, but it does not fit your plan. So in this case, because it does not fit your plan, you don't take it. And in my program, I do not allow people to be taking trades, even if everything is ticked on the strategy side, because it does not suit their plan. It does not suit their risk. It does not suit their capital. It does not suit their RR. Then they don't take it. So according to that portfolio that I've just shown you right now, I can go to it again. According to that which I showed you right now, definitely this guy must never take, even if I can give this signal, you are not supposed to be taking this signal because because you don't have, I call it because you don't have the budget. Your budget per trade is 23. Your budget per trade is $23. That one gives you per week is $23. That trade has exposed you to $28. It's out of your league, out of your budget, out of your capital. It is out of your risk. So it's not something to take. But for somebody who, for instance, had a bigger capital, all right. So let's say this guy was targeting or had a better, or perhaps had a better, or perhaps this guy had a better capital. If this guy had a better capital, for instance, he was planning to trade, either, perhaps he's trading a better amount. Let me just change the 5,000. There's the 5,000. I change it to 10,000. Then if I take this to 10,000, then it changes the capital. There it is. If this guy was trading $360, anything from $350, then that capital, that would have given him the allowance. That risk, that's exactly what I'm saying. For you to avoid risk, you must increase your capital. So in this instance, it shows that that guy would have now qualified to take the first signal and the second signal. Because the $48 is given to him, the risk at 0.01 would now be allowable. The exposure, even if the market will not go to your stop loss, but we still factor in the risk exposure. The stop loss, even if the market went up, should have been at, as I said, it's about 28, and the take profit, it's just at about 1:3 exactly. Let's check that again. That looks like it's 90. Yes, it's 28.30. This is 1:3. This is 1:3 indeed. So if that is the case, then that is the perfect example of those who are on a trading strategy of 1:3. So this is what I wanted to show you, number one. In the next 5 minutes, I'm going to show you again on how we look for those. So that's 1, 2 is 3, that's 2, that's risk, by the way, and that's exactly 3. So perfect. 1:3. There's the stacking. 1:3 on a $350, that's recommended. I also have looked in terms of what you guys can do. So if you do know planning very well, you should be able, there is something, there it is. I am now going to be showing you on when I scan my market, when I scan my charts, that intraday traders have got big opportunity here. There is the small, there is the, for instance, a pound dollar, which shows small risk of about 200. Yeah, this is about $200, $20 at 0.01 for one. I think this looks like it's 1:10 for $150. So they are. So every time, if you are a good trader, you'd be having signals like this. This is a market that if you don't have a plan, it's going to be difficult for you to know exactly whether you qualify or not. You're just going to be flocking with signals. This one shows this chart. We are preparing to short euro dollar, waiting for a small high. The risk must be 70 pips for risk, $7, 0.01 to make just about $266, about 26, just about 26. So $8, just about $7, $8 for about $25. So that's exactly what we're looking at right now. So let me just, I put my sell limit there. Then you put your sell limit to check if you would qualify. Check the budget. Check the budget. That's the sell limit. Modify. Right. 0.89 will be the stop loss. And let's check how much are you going to lose there, somewhere there. Just take it slightly up. That's about $9. There's the budget. Just about $9. 75 pips, $9.50. $9.50 is what? If you've got $9.50 as your allowance for your trading plan, you can go for this one at 0.01. That's exactly what we're doing. So this is what I recommend. This is what I call effective weekly intraday planning. This is possible for an intraday trader who is looking to make small profits trading a small lot size, the smallest lot size allowable. And now the risk is also defined for that smaller lot size, and so is the reward. So I hope you guys really find this to be very helpful. And as I said, this is going to be included in one as just as a value add, that if you join our intermediate and complete it, then at the end of your intermediate, then we'll begin to introduce you to trading plans, effective ones. The trading plans that will reduce your probability or your chances of losing your capital, completely even eliminating it. Because once you risk, or once you lose or have a drawdown of over 50%, there's something wrong. If you lose over 50% of your capital according to our standard, something is terribly wrong. Your risk to reward is not balanced. So this is what we encourage people, and I hope you guys enjoyed this for the evening. It is a recorded session. For those who could not understand every other thing, I will explain it. I'm hoping that I will have another time with you guys in the future to do some more free sessions with you. But as for tonight, this is where it ends. If you do have got questions, by the way, don't feel free. You can drop them. Each one of you have got the WhatsApp group. Drop them, or you can send them just on the side on my WhatsApp, and then from there we can chat. But I'm looking forward to be seeing you in your own mentorship sessions. And yes, I'm planning to come to Gaborone very soon, should we get those numbers, and also hoping that I'll also be in Mahikeng also very soon. If not, then we'll put together those two groups for Mahikeng and Botswana, the Mahikeng and the Gaborone group. Ladies and gentlemen, thank you so much. It was lovely talking to you. And as I always do when I sign out, today there's no Q&A. Like I said, we'll do the Q&A on the side. Tonight, as I sign out, I would like to say, let there be pips. So if you're struggling with pips, I will see you in our next class. Thank you so much, guys, for joining us. God bless.